Okay, so we are going to do BE82 on page 833, and I'm going to share an Excel sheet with you. So I'm going to stop sharing that, and I'm going to share the Excel sheet. All right, so we are going to work on BE82 on page 833, okay? So BE82 says, record the following transactions on the books of Jarvis Company. Omit cost of goods sold entries. So basically what they're saying is skip the cost of goods sold entries for this item, okay? So let's see. A says, on July 1, Jarvis Company sold merchandise on account to Stacy Company for $23,000. Terms, 2%, net 30. Terms are 2% 10, net 30. So we are going to go ahead and do that problem. So in this instance, we are the seller, and this is A. And let's see, I got to resize my screen. Hold on. Okay, this is A, and A is there. Okay, the date is July 1. We've got July 1. And what did we get? Well, in this instance, we got a promise to pay. The customer is promising to pay us. So that's an accounts receivable. So it's an accounts receivable unless it tells you it is a note. Okay. And we haven't got to the note section yet in this chapter, but just so you know that it's an accounts receivable unless they tell you it's a note. So we are going to debit accounts receivable, $23,000. And this says that it is for a merchandise. So we are going to credit sales revenue, not service, sales revenue for $23,000. Remembering that we are omitting cost of goods sold for this chapter only, just for this chapter, okay? All right, so now we're gonna go to B. And B says, on July 8th, Stacy Incorporated returned merchandise worth $24,000 to Jarvis Company. So that is B. So the date of the return is July 8th. So July 8th is the date of the return. We are the seller. So as the seller, everything does not go to inventory. When we're the buyer, everything does go to inventory, but as the seller, everything does not. So when we have a return or an allowance, we debit sales return or allowances. So we're going to debit sales returns or allowances for the amount of return that the customer is getting credit for, the $2,400. We're going to credit accounts receivable for $2,400. And remember, we are omitting the cost of goods sold part. That would come next if it's a return, but we're not doing that in this chapter at all. Okay, then we're going to go to C. And C says, on July 11th, Stacy Incorporated paid for, so they paid for the merchandise. So in order to do the payment, we still have to figure out all of the calculations, right? So the formula is sales minus any return or allowances, right? And that's going to give you your accounts receivable number, right? Then the accounts receivable number times the discount percent is going to give you the discounted dollar amount. And then the accounts receivable number minus the discount dollar amount is going to give you the cash amount, okay? Oops. So for this problem, I don't know what that is right there. It's left over from before. Okay, so for this problem, we have The sales was $23,000, right? $23,000 minus any returns or allowances. The returns or allowances was $2,400, right? So that's going to give us an accounts receivable number of $20,600. $20,600. And that is our accounts receivable number. We're then going to take the $20,600 times the percentage discount in this problem. And in this problem, they told us it was 2% times 2%. That's going to give us a discount dollar amount of $412. We're then going to take the $20,600 minus the $412, and that's going to give us a cash amount of $20,188. So we are going to debit cash because we're the one that's being paid. We're debiting cash, $20,188. $20,188. We are going to be debiting, oh, I gotta make this go down just a line. Here we go. Debiting sales discounts for the amount of the discount, which is $412. Okay. And then we are going to be crediting accounts receivable for the amount of $20,600, which is the amount that the accounts receivable account is currently after the returns and allowances. So I'm just changing this to currency so all the boxes look the same. Okay. All right, so this is a picture of BE82, page 8-33 in our textbook. Okay, I'm going to stop the video there.